The energy sector just led the market in performance in 2021, and the best energy stocks for 2022 are hoping for many of the same tailwinds to carry them to continued outperformance this year. Let's take a look at 10 energy sector stocks to buy now. Number 10. Nextera Energy. Nextera Energy, NYSE, NEE, is one of the country's largest electric utility companies. It's also the global leader in producing power from the wind and sun through its energy resources segment. That business sells clean energy to other utilities and end users around the country. Both businesses generate relatively stable cash flow. It sells and distributes power backed by government-regulated rates and fixed-price contracts with customers. This business model is very resilient because business and households need a steady supply of power. The company has one of the best financial profiles in the electric utility sector, and it has one of the highest credit rating in its peer group. Nextera also has a conservative dividend payout ratio for a utility, which adds to its strong financial profile. Those factors enable Nextera to pay a stable and growing dividend, making it an excellent renewable energy dividend stock. Number 9. Exxon Mobil. Despite being the largest energy company in the US, Exxon Mobil, XOM $66.75, hasn't been king in recent years. Lower commodity prices have continued to hurt its shale oil assets, while the pandemic dented demand for liquefied natural gas, LNG, and other fuels. Over the past couple of years, Exxon has been cutting costs and selling assets in Asia, Europe, and Africa, as well as in the Barnett Shale, allowing it to focus on its best-performing assets. Now, Exxon's break-even cost to cover capital expenditures and dividends over the next 5 years is a meager $35 per barrel, meaning anything past that is pure upside. In its third quarter, for instance, Exxon generated nearly $6.8 billion in profit versus a $680 million loss in the year-ago quarter. Cash flows from operations were $12.1 billion, allowing Exxon to not only cover capital investments and its dividend, but reduce its debt. Number 8. Magnolia Oil Gas. This is a relatively new company, founded in July 2018, that explores for and produces oil and natural gas, primarily in the Eagle Ford Shale and Austin Chalk formations. And its limited operating history is a bit of a blessing. Because the firm went public at the tail end of the last energy downturn, management started out with a lean and mean business model. That includes only owning low-cost asset, living with its operational cash means, and being prudent with its debt profile. This has worked well so far. For instance, back in 2019, when WTI averaged $60 per barrel, Magnolia recorded pre-tax net income of $100 million. Based on consensus estimates, with 2021's average of $61.25 per barrel, Magnolia should record more than $570 million in pre-tax profits. Number 7. Phillips 66. After you pull crude oil or natural gas out of the ground, you need to do something with it in order to make it usable. That's where the downstream or refining sector comes in. The base commodity is cracked under pressure into various fuels and other materials. One of the largest independent oil refiners in the US is Phillips 66, PSX $78.32. The key for PSX is that the firm isn't just focused on producing gasoline for cars. It also has a hefty dose of chemicals production via its joint venture with Chevron, CVX. Here, Phillips is a major producer of high-density polyethylene, HDPE, plastic, polypropylene plastic, and various other chemicals. For PSX, this focus on chemicals production rather than just transportation fuels has paid benefits. Its refining and midstream businesses has also seen big increases in earnings last year. Number 6. Baker Hughes. It has been a wild ride for Baker Hughes, BKR $25.68, to say the least. BKR has historically trailed one of the bigger oil services stocks, namely Halliburton, HAL, and Schlumberger, SLB. Then it was brought out by General Electric, GE, in 2017, only to be divested by the industrial conglomerate in 2019, with plans to sell its entire stake in the energy firm over the next few years. Baker Hughes had more stock tickers than most companies and recently went through a relisting in the Nasdaq. Number 5. EOG Resources. Before fracking and shale was a thing, EOG was a first mover into some of the more prolific shale fields in the US, including the Permian Basin, Eagle Ford, and Bakken. This allowed the firm to amass some big-time acreage in these massive shale fields at rock-bottom prices. The win for EOG has been a low cost of production throughout its history, and this continues today. According to EOG, the company can break even with oil at just $30 per barrel. And at just $36 per barrel, the firm has enough positive cash flow to fully fund its regular dividend payment. Investors have been the ones to benefit, with EOG boosting its dividends twice this year and declaring a big $3 per share special dividend. Number 4. Marathon Petroleum. Like the aforementioned Phillips 66, Marathon Petroleum, MPC, $68.24, was also a refiner of crude oil. In this case, MPC is the largest domestic independent refiner of crude oil, with 16 refineries across the US. This position has provided MPC with a steady base of earnings since its spin-off from exploration and production firm Marathon Oil, MRO, back in 2011. Those earnings have improved as gasoline demand has moved higher in recent quarters, with MPC reporting adjusted earnings of 73 cents per share in its third quarter, compared to a loss of $1 per share the year prior. The growth story of Marathon comes on several fronts. The firm has managed to reduce its average refining cost by about $1 per barrel over the last 2 years. Those are significant savings that go a long way to help improve the company's profits. Number 3. Conoco Phillips. Back when oil prices crashed in 2014 and 2015, COP was the first major oil producer to get lean and mean. That meant slashing its dividend, selling underperforming assets, living within its cash flows, and focusing on low-cost shale assets. As a result, Conoco has been able to navigate subsequent oil crashes and downturns with relative ease, including in 2020. While COP did lose money along with the rest of the energy industry, it was still able to get its dividend going through operating cash flows. Number 2. Devon Energy. After natural gas cratered back in the late aughts, Devon Energy, DVN, $46.61, has been off the radar of many investors. But in that time, DVN has transformed itself from being a nearly 100% natural gas-focused energy stock into one with plenty of diversification in its portfolio. Because of the jump in crude oil prices, Devon has managed to produce nearly 8 times the amount of free cash flows than it did at the end of 2020. With that, it's also managed to increase its dividend nearly 71% since the start of this year. Those gains should continue in the new year as well. Devon estimates that, with oil at $80 per barrel, it should be able to produce a free cash flow yield of around 18% from its drilling activities. This should give it between $4.5 billion and $6 billion in free cash flows to hand out to investors, a greater than 40% improvement over 2020's numbers. And number 1, Chesapeake Energy. Chesapeake Energy, CHK $65.19, has had its fair share of drama over the years. From secret hedge funds to lawsuits to a bankruptcy, the company has seen a lot. But like a phoenix rising from the ashes, CHK is nothing like its former self. In fact, it's pretty darn good. After emerging from bankruptcy protection in early 2021 and shedding its huge debt burden, CHK is now a lean and mean energy firm, getting back to basics with its acreage and drilling plans. This means focusing on prolific natural gas plays like Haynesville and Marcellus shales. All in all, Chesapeake has roughly 960,000 net acres in these 2 core fields alone. Do let us know in the comments which one of good. Please subscribe to the Stock Advisor. Thanks for watching.